Welcome in. This is the Chit Chat Stocks podcast feed. My name is Brett Schaefer, and today we have a special cross-promote podcast episode from our friends at Investing Unscripted. This is a podcast for those who like unscripted investing conversations, want to learn as a beginning investor, and hear fascinating interviews from authors and investment analysts. The title of this episode is Back to Basics. Let's get to it.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured, U.S.-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey everybody, welcome back to Investing Unscripted, where we ask the hard questions about investing. I'm Jason Hall, joined by my good friend Jeff Santoro. Hey, voice of the people. How are you, buddy?
Hey, I'm good. The listeners won't know that it took you several tries to do that introduction. So congratulations on finally nailing it. I'm really proud of you.
Oh, they know. They know.
They can just assume.
Yeah. As many times as we've talked about it, they absolutely know. It took me multiple takes to get the first 30 seconds of our show out of my mouth. We got a fun show planned. We're gonna get back to basics, Jeff.
We are. You know, it's the beginning of the year. I feel like this is the time of year that in a lot of aspects of life, people are thinking about restarting, new beginnings. And we thought it'd be fun to have a conversation where we just revisit some of the basics about investing and the way we think about it. So it's going to be a little unstructured of a conversation, but we have some kind of main points we're going to hit on. So it'll be back and forth, asking each other questions. But I would like to do a little call out to our listeners here. If there's anything that this episode sparks in your minds in terms of other back to basics type topics you'd like us to discuss, shoot us an email or hit us up on social media. Let us know. You can leave comments in the Spotify app if that's your preferred way of reaching us. But for the first month or so here, I think it'd be fun, Jason, if we got, some listener ideas about like, hey, here's a basic concept I'd like a conversation on, or here's something I struggle with, or here's something I want to learn more about, just to kick things off here in early 2025.
You need to remember, Jeff, one of our themes for 2025 was where the listeners step it up.
That's right. We're tired of pulling all the weight here.
Yeah. Come on, people.
On this podcast that we make.
But in all seriousness, we do get call outs, and obviously we do the mailbag, and we have a lot of questions we go through. And every once in a while, a mailbag question turns into a topic that's really big enough for an entire show. And we generally have a pretty good idea of what we want to talk about every week. And we have a list of ideas and different things. And of course, topical stuff happens that drives the conversation a lot of times. But we do love to hear from listeners with ideas. So if there is a topic, like Jeff was saying, definitely send it to us, whether it's a kind of a back to basics thing, or even if it's something maybe obscure and kind of niche that you want us to delve into. I think that can be a really useful conversation, and it can help just keep us grounded too, right? It's really easy to kind of chase the thread of whatever's happening in the investing world. And something I put on Blue Sky today is that I've found that the thing that oftentimes feels like it's getting the most attention, that matters the most in the moment, is the thing that doesn't matter at all over the long term, right? And the things that matter the most over the long term are the things that we often don't spend a lot of time thinking about in the moment. So it's a good way to kind of remind us about that too.
Yeah, for sure. And the last thing I'll say about it, and then we can dive in, is it also helps us, I think, not to get too deep in the weeds. One piece of feedback I've gotten from some listeners over the past couple of years is, sometimes we'll dive into a topic and not explain it, or we'll use an acronym and not say what it means, or we'll talk about a stock and not give the ticker. So it'll help us go back to our roots of helping anyone listening who might be on the earlier end of their investing journey as it pertains to getting started and learning more. Having said all that, let's dive in here, Jason. So the first piece I wanted to kind of start with, as I was thinking about what it means to me to go back to basics, this is where my head went, and you can tell me what you think about it. We spend so much time, you and I, both on the podcast and just talking to each other offline, talking about stocks specifically and investing in that aspect, because that's the thing you and I both enjoy the most. And you write about stocks for a living, and I write about stocks as a part-time job. And I have to stop and remind myself over and over again, stocks are a small part of my invested wealth. Stocks are probably not going to be the main driver of me reaching my financial goals. They might expedite it. They might be
in the aggregate, but
right
individually, right?
Correct.
Yeah.
Well, no, even in the aggregate, I guess there's a chance that they do become a substantial part of my portfolio over the next decade plus. But I guess my point is I'm going to reach my goals because of all of the index and ETF and mutual fund investing.
Well, when I say in the aggregate, I mean that's what composes those particular investments.
Oh, yeah, I heard you saying, but I thought you meant the aggregate of just my stock portfolio, because even that I think is going to not be the main driver, I should say.
But I think your point is that we spend an outsized amount of time talking about things that will typically have a pretty minor impact on the big picture of our returns.
Yeah, and yes, that's a good way to say it. And I think for me, when I have conversations with people offline, like not involving the podcast, that are about investing or personal finance or anything like that, I don't give advice. I don't feel like I'm qualified to. I share what I think. I share my experience, like what I've done in my life. But I find myself, when the closest I get to advice with 99% of people is it's not about stocks. It's like, what are your goals? When do you want to reach them? What do you already do? How much do you save? Do you watch your budget? Like, it's all that kind of stuff. So the place I wanted to start with, like a back to basics conversation, is simply the idea of knowing what your financial goals are. And then having the conversations, if there are other people in your life that are tied to your financial goals, they got to have those conversations. And that's going to be very different if you're 19 and you're listening to this. By the way, get a life. If you're 22, or if you're 28, if you're married, if you're single, if you have kids, if you have no kids, if you have grandkids, whatever your situation is, that's going to differ.
Hey,
but
Jeff?
I feel like first principles needs to be, what am I doing all this saving and investing for? Right? Like, what is my end goal?
Yeah, no, and that's exactly right. But first of all, really good job instilling confidence in the teenager who's already weird.
So if there's a 19-year-old listening to this, they should know that A, that was a joke, but B, even if I knocked your confidence down, you'll be happy when you're my age and you were listening to an investing podcast when you were 19, because that is not what I was doing.
Yeah, you will be in a much better situation than Jeff or Jason.
Yeah.
There's no doubt about that.
You won't have to do a podcast for 13 cents every 1,000 listens to make ends meet.
Yeah, we don't do this for the money. Narrator. They do it for the money.
Anyway, we're getting silly here. Let's bring it back.
We're getting very silly. We haven't done one of the silly rants in a little while, so it's okay. But no, I think you're right, because it's really investing. The whole journey can be as simple or as complex as you want. And I think that is one of the realities of people that are passionate about stocks or are interested enough in it that they're going to be listening to a podcast about it, is that we tend to add complexity to it, right? And we add complications to it just through the very nature of buying more stocks, owning a larger portfolio of individual stocks where you need to be doing more research to understand what you own, keeping track of everything. So when you have new money to add, that you're consistently diversifying and investing it where you think the best ideas are for your long-term goals. But I think you're exactly right. I think it's such a healthy thing to do, to step back and really focus on the basics. I mean, if you think about professional athletes, here I'm going to use one of my professional athlete analogies. And one of the things that you consistently see with the most consistently skilled athletes is they consistently do the basic things over and over again. They work on the basics. They work on the fundamentals, taking hundreds of shots, taking thousands of swings, working on repetition of their mechanics, like those basic things that even with all of their understanding of whatever their sport is and their own abilities and the knowledge of the people they compete with and the things they have that are skills that gives them advantages over certain players and vice versa, focus on those basics is so important. And I think that's something that we as individual investors should do more often. And at the beginning of the year, it's not a bad time to really sit back and almost start with a clean slate and say, okay, if I was starting from fresh today, what would I say my financial goals are?
Yeah.
Right.
Because you have to, what I found, or the way I think of it is, if you don't have a clear idea of what you're trying to accomplish, you'll end up being pulled in the direction of any number of things, right? Like what's interesting, what's hot, what people are talking about. And I feel like that'll get you to chase. My biggest worry is that makes you chase the things that you think will get you rich fast. And those are not the things that are going to build the wealth you need to meet your long-term financial goals, or at least that's the way I think about it.
You start risking what you can't really afford to lose, trying to capture what you don't really need to have.
Yeah. Or just, so here's an example. I was talking to someone recently and they made it some sort of comment like, because I know I do this podcast, and they said something along the lines of like, I really need to start buying some stocks and get my life together, or something like that. And all I said was like, I'd love to talk to you about it. But my thinking was, well, that's not really the place to start, right? Because that
stocks as a starting point is probably a terrible way if you need to get your life together.
Well, it read to me like the way I took that was, I saw someone tweet about NVIDIA and I need to do that.
Yeah.
You know what I mean? And this person's probably in their late 30s, I would say. So, not someone who's about to retire, but also not someone who's 22 and just starting out in professional life. So I offered to have a conversation, and I said, there's a lot of stuff to talk about ahead before you know what to go do and buy. And then we have not had this conversation yet, but I do feel like in a world where it's so easy to get influenced by influencers and what people are talking about online, and it's generally not their failings, it's all of their successes, and even people just straight up giving facts. Like today, I woke up this morning and someone just tweeted a screenshot of NVIDIA's stock price and said like, NVIDIA new all-time high pre-market. Fine, just that, I don't think the person was doing anything wrong. They were just stating a fact. But I could absolutely see someone who's in their late 30s and feel like their financial life's not together, seeing that and going like, I got to buy that.
Mm-hmm. You're exactly right.
And that could be part of a strategy, but that in and of itself is not the strategy. That's what I'm getting at.
Yeah. And I think the other thing too, is that as we spend time doing something and we're in the middle of it, we're in the weeds, we're in the middle of the forest, it's really easy to lose track of the path and where we are on that path, and to start making objective decisions. We start reacting to the market and reacting to what our portfolio is doing in the moment and what it's done over the past 6 weeks versus what it's done over the past 6 years and what we needed to do over the next however long until our various financial goals are going to arrive. And it definitely moves us into decisions that are more influenced. We'll talk about this often by things that are incentives to do certain actions versus maybe really focusing back on what our goals are and are the things that we're doing setting us up for long-term success and short-term success too? Or are they potentially creating pools of risk that could, upend some of our goals? So I think a big part of it for me is sitting down fresh and outlining financial goals, and not just what the goal is, but when it is and how much it's going to cost, like within some degree of directional accuracy to what it's going to cost. Some examples, Jeff, you and I share in common. We have kids. We want to help those kids pay for their post-high school education. My son is younger than both of your sons. You've got one that's pretty close to college here. My son's in second grade. So thinking about how you would want to think about that goal of helping pay for education for your oldest son versus the actions that I'd be taking for Tate, very different places in terms of where are you on track to that goal? What do you need to be changing? What do you need to be doing differently? Then we have retirement. We have all the other goals along the way. The other thing too is I think it's more than just like the investing stuff. It's just the personal finance, like the block and tackling stuff. It's like, how am I doing on building up a safety net, right? The emergency fund. How am I doing on making sure I've got the money set aside for trips I want to take later this year? Little things like that, sure, they're different from investing, but they're dealing with how you're allocating all of your resources. And it's easy to screw up one by focusing too much on something else.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. Yeah, and it reminds me again, this is just another conversation I've had just in the past couple of days with this person is probably 30-ish, is a freelancer, so doesn't have a W-2 steady income kind of job. And I found out this person always maxes out their Roth IRA. And I was really impressed by that because, like, for a younger person has inconsistent money coming in, I would imagine there are pressures about, like, great, I got this money today. I don't know when the next check's coming, but he's able to put whatever the max is now, $7,000 a year or $6,000 a year, $7,000 a year, whatever it is, in his Roth IRA. So I said, that's great. Like, I'm like legit like proud of you that you can do that. That's awesome. And the response was, I can't believe they didn't tell me this in high school. That was the first thing. And then also, it's just really hard. It's really hard to save and invest for the future when you're like a freelancer.
Yeah.
And again, we talked about maybe having a conversation in the future about it, but it reminded me that that's someone who at least is cognizant of the fact that I have to save money for like my 80s. You know, like, right. I need stuff down the road. And that might be enough of a first step to then figure all the rest of it as you go through life, right? But just having that idea at the beginning of like, all right, I know where my end goal is going to be. So yeah, it's a timely thing for me to have this conversation just because I've had these other interactions recently that are tied to it. So you touched on it, but I think it'd be a good time to go to this part of the conversation, which is, you know, we did an episode, I want to say it was last year, about the difference between goals and incentives. And we obviously don't have to rehash the entire episode. People can go back and listen to it. That feels like the next logical step in our conversation today, like the difference between having those long-term goals and the incentives that are maybe short-term or different. And the thing that I remember back from that conversation is like the difference between the individual stocks in your portfolio and the bottom of the brokerage statement where it tells you the total, and thinking of like your entire pot of invested money through that lens. Like, it's not so much about this stock or that index fund or this crypto or that real estate. It's more about what's the aggregate number and how is that doing relative to your long-term goals. So I think that's a good next place to go.
Yeah, I think you're right. So that was episode 49. That was April of 2023. So getting close to a year ago, about 9 months ago at this point. And I want to stay on that for just a second before we dig in a little bit more. I think the thing that I really want to highlight that we talked about in that episode is that, and I used companies' goals versus how management and employees are incentivized as a good way to think about it, because the bottom line is that there's how we objectively should act, right? Everybody knows they should set some money aside for retirement. And for most people, they know it should be more than they're setting aside now. Everybody knows they should have an emergency fund, right? Everybody knows they should eat more vegetables than they're eating now, and they should exercise more than they're eating now. But why do we behave the way we do? Because despite the fact that objectively we know that there are other things that we should do, we all are faced with incentives in our lives that typically pull us in different directions. So if you're an executive at a business and the largest portion of your bonus is tied to revenue growth versus something like a per share metric like book value per share or earnings per share, or something along those lines, you could go out and find a company to acquire that is going to grow the company's revenue 10%, even if it doesn't create per share value, and your bonus goes up, right? So it incentivizes bad behavior. Think about what happened with Wells Fargo. And this was kind of the catalyst that eventually led to Warren Buffett selling Berkshire's stake, and it had been one of its largest stakes for decades. And they were creating these positive and negative disincentives for branch level people that were dealing with clients to create fake accounts, because there was these push to grow accounts, even through illegal and unethical means that literally cost people money, because they were being pushed so hard to grow deposits, and they were not incentivized to act in ways that were in the best long-term support of the business, right? And their clients as well. So I think one thing that we talked about on that episode, Jeff, is like, and you mentioned this earlier, talking about how it's important with these goals that you need to be aligned with your financial partners in your life about these things. And I think this comes in with your kids too at some point. If you set up a UTMA or a 529 or some other instrument where they're going to be coming into any size sum of money that they're going to be able to control, or that's going to be there to pay for their education, I think it's important for the kids to understand it's there too and what's going on with it. In the same way that with your retirement and your savings and all of those things, if you have a spouse, you have to be as aligned as you can with that person, because if you're not, you're doing things that you know are going to freak them out and those things go bad, your incentives are going to be to fix it as fast as you can and hide it from them, which is going to incentivize you to make more mistakes. So incentives are amazingly powerful, and understanding the things that influence you that can run counter to what your goals are is so incredibly important.
Yeah. And I think that's a scary thing, or maybe scary is not the right word. I think it's something to be cognizant of if you are an individual stock investor, especially one who is like locked into what other people who like to buy stocks are doing and saying, because I fight that incentive thing all the time, even if it's like low key joking with you about a decision I made or ragging on you about a bad one you made. That's still at some level, like there is this like incentive thing in my brain of like, I want to buy stocks that do better than Jason so I can bust his chops about it. And I'd be lying if I said that didn't probably more than it should make me think about what I do. But
I'd love to hear that.
But that's an example. I mean, but I think that's human nature, right? If you're subscribed to a newsletter, or you're following someone listening to this podcast, or following someone on YouTube or anything like that, there is always going to be some level of, oh, the decision I made was better than or not as good as this decision this person made. But that's all short-term thinking, like that, that could contribute to or could pull away from your long-term goal, but it's not the long-term goal. And to your point, that could easily incentivize you to either pull back and be like, all right, I'm going to stop investing, or I'm going to wait till the market pulls back, or I'm going to double down and try to, it's December 10th and I'm trailing the market. So let me go crazy and try to beat the market in the last 2 months of the year. Stupid stuff, right? And that's why I just keep coming back to, am I on track? Am I on track for the long-term things I want to do?
Yeah, no, that's right. And again, I'm going to say the short and medium term matters a lot too, because a lot of times the big mistakes, the ones that have the biggest implications, are when people are so focused on their long-term goals, you've spent 5, 10, 20 years building out a portfolio of stocks and investing and watching the market go up and the value continue to move higher. It can be hard to make that transition to stuff that's more boring or not as fun or that you're not as interested in, like moving 10 or 20% of your wealth into bonds. That's nowhere near as much fun to talk about. I'm sorry, Jeff. Wake up, Jeff.
Oh,
Jeff,
sorry. I just dozed off there.
I know. I use the B word. It happens. But the key there is that this can be one of I think, the most catastrophic mistakes, because when people should begin to make that transition is generally when they've created 3/4 or more of the wealth that they're going to create. And they're risking much larger sums of money at that point, especially at a period in time where they're not going to have time to recover before they're going to need to start turning that asset into money, right? So I think that's one of the things that's really important about taking that step every year and really looking hard at your goals and when they are, and wiping the slate clean and saying, okay, if I were building an asset allocation today and I had the value of my portfolio and it was sitting in CDs, what would I do with it? How would I allocate it? And thinking about reallocating it from there.
Yeah. And I want to say one thing about that, and then I want to ask you an unscripted question that you're not ready for.
I'm ready for it.
The thing I want to say about it is that's what I found. So I had been telling myself for years that I need to meet with a fee-only financial planner just to see if I really am on track. And I finally did it a couple months ago. And what I learned through that process was coming into that conversation with specific questions I wanted to know about was helpful. And it's related to what you just said of like, you'll probably, if you're someone who pays attention to all this, which you probably are because you're listening to this podcast, you'll probably be a point when you get to whatever age it is for you, where you start to think to yourself, like, is the time now that I need to start thinking about this? That's the time to go ask a professional, in my opinion, right? But you're going into that conversation with that question in mind, right? Okay, I'm 45 years old. I have 2 kids. They're 16 and 12. The question I would want to ask is, look at everything I have. Am I too stock heavy? Having a professional opinion on that, I think, can be helpful. That may be the thing you need to kind of nudge you if you are supposed to be starting to transition to something a little less risky or a little bit more on the capital preservation side versus the capital appreciation side. But the question I want to ask is this. So one of the things that I was thinking about in terms of goals versus incentives is there was a large period of my adult life where the only time I thought about or saw the amount of money I had invested was when I would get the paper quarterly statement in the mail from my retirement account or my wife's retirement account. It was before there probably were logins back then. I just never made them because I didn't care. And I don't know how much of that was age. It's really easy to not worry about that stuff when you're in your 20s versus just the technology was different back then. But there was a understanding and calm that I had about the markets when I finally got into buying individual stocks and paying more attention to all this stuff 4 or 5 years ago, that I don't think would have been there had it not been for 20 years of being forced to sort of not follow it closely, if that makes any sense. So I'm curious what your thoughts are as it relates to keeping your eye on the prize, so to speak, the long-term goal, about checking your portfolio, checking your balances, checking your, especially if you're, or whether you're a stock investor or just an index fund investor. Like, how do you think about that?
So I think as a starting point, if there's a lot of emotions behind your checking of your portfolio, then not only do you probably need to check it less, then you need to figure out what is causing those emotions and how do you inoculate that. And most of the time it's spend less time logging into Fidelity or E-Trade or whatever and just spend more time reading. I know this is going to sound like eat your vegetables, right? You showed up for barbecue and somebody just handed you a kale salad, but it's the blocking and tackling. It's the understanding what you own, learn more, trade less, so to speak. And what I mean by if there's large emotions around it, particularly if you're checking it because you're nervous or worried or anxious, right? You probably have multiple problems. And I would say that the most likely is you probably don't know enough about what you own to find a way to not be driven by your fear or concern about your portfolio going down, that you're having to check it every day. You're not going to be able to outrun the market, I'm telling you, because what's going to happen is it's going to start falling and you're going to be like, oh, it's going to come back and it's going to fall some more. And then a month's going to go by and it's going to be down 20 or whatever %. And then you're going to say, okay, all right, I'm done. And you're going to capitulate when the downturn is over, right? It's human nature, because you're reacting based on what the stocks are doing and you're not reacting based on having some fundamental knowledge of what you own. And so you also probably have a little bit of an asset allocation problem too, where you're too stock heavy because you're focusing on the volatile part of your portfolio too much. From the same perspective, if you get a super jolt from checking it, if you're enjoying it maybe a little too much, maybe it's become too much of a spectator sport for you. Or again, it's finding that like healthy balance where emotions aren't significantly driving it. As someone that works professionally in the field, I use that as an excuse way too much to look at my portfolio. Frankly, I could still thrive in my career and look at my portfolio 90% less. So I'm being exceptionally hypocritical. Maybe I'm kind of looking in the mirror while I'm saying that.
Well, it's interesting because I love that you talked about knowing what you own. I think we should explore that for a little bit, because I think we should put aside for a second the knowing what you own aspect for someone who like truly doesn't care about any of this, because they're probably not listening. But I do think knowing what you own is super important for someone who has enough interest to be listening to this right now. So for me, one of the first things I did when I first started getting interested, it was actually my interest in individual stocks that got me to go back and look at what I already was investing in. Like that was the first time I like logged into the website for my work retirement account and actually clicked on the fund that my money was going into, and then found the PDF that's really long and full of information and tried to see like, what is this actually?
Prospectus is the word you're looking for.
Yeah, I know. What is this actually? What am I actually invested in? Mm-hmm. And I was so naive that I was surprised to see that when I could click and be like, oh, wow, 10% or whatever, 2%, 5% of this money is in Apple. Like I had no concept that this pool of money was actually in individual stocks. I know that sounds like incredibly stupid.
That's incredibly typical.
Right. I just thought it was like this pot of money that almost like how interest works, I guess is how my brain thought about it. Right. Like It's like stock market interest, but when you actually look at it and go, okay, so I have $10,000 in this fund, right? Just to pick a round number, and 2% of this fund is in Apple. I own $2,000 worth of Apple. That was
$200 worth of Apple.
$200. Sorry. That was mind blowing for me. I was like, oh, and I finally started to understand like what I owned as it pertained to these like big index and mutual funds that were in this retirement account. And then I was like hooked. I was like, well, let me go log into my wife's account and see what she owns. And she was in a target date fund. So I was able to see like, well, what is the target date fund invested in right now?
When you woke up, you talked to her about reducing her bond exposure.
Yes, that was my first step, obviously. But to me, it's like, that's the highest level of understanding what you own, because those are the big funds. Those are probably the thing that most people have a lot of money in, because my guess is most people start investing through just their work retirement account before they start thinking about buying individual stocks. If I was to guess, that would be the majority of people out there. One more thing about that. I think that's important because you should just know generally what you're invested in, right? Because like I found out recently, I owned a lot more of the Mag 7 than I thought I did, just by going through all my different mutual funds and ETFs and index funds and adding it all up. But let's flip the script and talk about knowing what you own if you are buying individual stocks. I think that's also really important.
Yeah, it absolutely is. And Peter Lynch was the biggest proponent talking to the investing world about knowing what you own and what you see in everyday life and that sort of thing. I think you kind of have to be careful with that, because there's tons of people that worked in the automobile industry that if they simply focused on investing in the big automakers who thought they would continue to dominate, and still on a volume basis they do, and completely dismiss Tesla, which is what the entire industry did, they suffered as the result. I think specialized knowledge can be really, really valuable. If you're a biochemist and you work for a biotech, you probably have specialized knowledge that can help you identify biotech stocks, particularly the ones that are still startup or they're still in clinical phases. They don't have anything commercial. You have a better chance of being to identify potential winners that might have blockbuster or commercially successful drugs, right? So I think you have to be really careful with that. But there is a lot to be said for just the idea of seeing things and identifying them and saying, hey, this is a trend. This is big. All right, now let's go do some research and find out if there's money to be made behind it. Study the industry, study the companies in it, find the company or companies that look like they can be winners, figure out if they actually have durable moats against the competition. What are those moats and what makes them durable? Understanding like stuff like Tyler Crow talks about this a lot, our friend at Misfit Alpha, understanding how is management incentivized. Because if executive pay, I talked about it earlier, is tied to things and can incentivize actions they can take that are going to be good for their compensation, but aren't necessarily good for shareholders, the thing that's good for their compensation is the thing that's going to happen first. Even that doesn't mean they're unethical people. That means they're people, right? So understanding all of those little things is so incredibly valuable, not just to helping find better investments, but to avoid all of the mistakes that we make along the way based on acting based on what the stock price is doing and not what's going on with the business or the industry or the competitors.
Hey, everybody, we'll be right back, but first a word from our sponsors.
All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA-registered SIPC-insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit-chat about investing every single week. From hot stocks such as NVIDIA and Celsius to hidden small-cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
I'm so glad you said that, because as you were talking, I was thinking back to like when I first started buying individual stocks, and looking back, I now realize every single decision I made in those first couple months before I learned enough to stop doing this was based on price. And that manifested itself in a couple ways. So like, first of all, I started out with an account at Robinhood, and they have all these lists, top 100 stocks and things like that. I don't remember the rest because I don't have the account anymore. But my method of buying stocks was like, scroll through that list, see a company I know, mostly, right? Oh, I know Apple, I know Google, whatever. Click on it. Notice that the chart go to like last 6 months, last 3 months, last year. And if all those were like generally up, I'd be like, I'll buy that. Like, right. That was it. So that was like level 1 for me. Level 2 was like, all right, I graduated to Schwab. I opened a Schwab account. I was like, I need something a little bit more adult. But then it's the same thing there. They have these like little reports you can open. And I'm sure every brokerage does this. I don't look at them anymore. I use Fidelity now. I'm sure they have this too. And they tell you like, basically like, there's like scores and numbers, like this is a buy, this is not a buy, it's a 5 out of 10, this is a 2 out of 10. And I didn't understand any of that. I was just like, Schwab says this is a good stock, I should probably buy it. And that I think is completely normal. While I do think I'm an idiot for not understanding that my retirement accounts were in stocks, I don't blame myself for not knowing that that's not how you invest. Like, it's given to me by the brokerage. Like, surely they have my best interest in mind. No, they make money every time I trade. That's what they have in mind.
I'm glad you said that, because
talking about incentives.
It's about incentives. And the bottom line is that just because your brokerage doesn't charge you a commission doesn't mean that they're not making money, right? Because they have deals with market makers that make a little bit of money on the on the trading, right? They're the party in between buyers and sellers, and they make a little bit of money on the price.
Fractions of cents.
Yeah, just fractions of cents, and that's all it takes. But the key is that the brokerages, they get a little bit of that action too, right? And there are other things too. Asset management, of course, they want you to buy their ETFs and their mutual funds and all those sorts of things that they're going to feed to you as well. But they're doing just fine is the key. And if you're not directly paying them, you're the product, right? You're not the customer. And then online brokerage accounts where you get free trading, you're being sold. Your trading volume is being sold.
And look, I get, this is why, like, I've kind of landed in a spot where I don't want to say that if you don't want to do any research, you shouldn't own any stocks, because I do think there are ways to do that. Like we've talked about, you can outsource your research to a investment service that you pay for if you'd like. I wouldn't do that personally, only because I'm interested in it, but some people do, and that's fine. But that's why I feel like if you're trading the way I just described and finding that you're not successful over a long period of time, you should either learn more or just buy index funds. Like, because you're going to end up getting pulled by other people's and other companies' incentives that are not aligned with you making winning investments that are going to help you reach your goals.
And we talked about it a lot back in 2021, 2022, about how the market whipsawed in 2020, right? The crash end of February to end of March 2020 during the pandemic, the market fell well over 30% in a month, and then basically fully recovered. You know, we went top to top in 9 months, and we've never seen that sort of recovery happen that quickly. And I don't know, something like 70 or more percent of stocks went up over that period, like this massive percentage of stocks. And we know the numbers are clear. Most stocks don't generate great returns for investors. It's a small percentage. And to a certain degree, 2024 was another one of those years where this really, really high percentage of stocks generated positive returns. And I wanted to mention that, Jeff, because if you're somebody that's been trading a lot and you had a lot of success in 2024, you're not a fast swimmer, probably. I'm sorry to tell you, you were swimming in a fast-moving river in 2024. And it's not typical to get those sorts of things. So step lightly and maybe leverage that success and start shifting the proceeds of that success into something that's going to be more successful over the long term.
Now, I'm glad you said that, because I was thinking about this the other morning. I think it was Ben Carlson in his what's his newsletter called? Wealth of Common Sense.
Yep.
Just put the full year returns in a chart from 2020 to 2024, that 5-year span. And it was like every year's either up 20, down 20. Like there was no up 2, up 3, something like that. And I realized I have no idea yet if I'm a good stock picker. I don't feel like I will know that until I'm much further in the future. And you could probably say that about any 5-year period, really. But this one in particular, if you think about those 5 years, 2020 was insane.
The market's basically doubled over the past.
But like just the individual years, like 2020 was exactly what you said, right? Like massive drop down, complete recovery. 21 was just a continuation of that recovery. 22 was a long downturn. And then it was 2 straight years of 20 plus gains. 4 out of those 5 years, the only really prolonged stretch I've been through as a stock investor is the 2022 downturn.
Yeah.
I have to slow my roll in terms of the way I view my own, again, which is why I try so much to focus on, like, I'm going to reach my financial goal. Because otherwise if you're going to
be just starting out and trying to figure it out, it's a hell of a good time to do it when the tide is rising. So that's definitely a positive. But one thing that's really interesting about 2024, even as a lot of times people kind of conflate, they might say, well, the stock market went down a lot in 2023, so it was a volatile year. Stock market went up a lot in 2024, so it was a really volatile year. And the volatility is more the whipsaw action. And 2024 wasn't a super volatile year. There weren't big swings in one direction. Yeah, we had a pretty decent little sell-off there at the end of the year, but historically speaking, it wasn't substantial. So that's another thing that made 2024 kind of an oddball, is that it wasn't super volatile. And that can be really misleading to investors about what to expect going forward.
So the last place I think I'd like to talk about basics because I think we should probably focus on the stock buying and selling aspect of investing for the last little bit here. Because again, I think that's where most of our listeners are probably thinking about. So let's talk about buying and selling. Like we talk about those two things in multiple episodes throughout the year in different contexts. We've done whole episodes on buying and selling, specifically selling. But as you think of those two actions through the lens of basics or a framework, like if you're just starting out or if you're kind of resetting, let's start with buying. There's a lot of aspects to that. When do I buy? What do I buy? With how much money do I buy? In what account do I buy? And that's going to be different for every person, but there's got to be some like basic tenets that at least you have in mind for yourself.
I'll start out by saying that I think broadly, if you are an investor that's dollar cost averaging, whether it's into index funds or just your 401k or retirement plan through work, where it's just every pay period, or you're dollar cost averaging into individual stocks or ETFs or whatever with your own money, and you have a plan where you buy every month or once a quarter or whatever, I will say that broadly, if you stick to that way of investing over a multi-year time period for many, many years, when you buy and valuation, trying to catch the perfect valuation when you're looking at maybe a few percentage points up or down over a 1 month period when you decide to pull the trigger, it's not going to be the biggest determinator of your long-term success. The fact that you are regularly buying and you're getting that exposure to the market through the highs and the lows of the market cycles, simply the fact that you're actively putting new money to work regularly, and then the thing that you're doing the most in holding, because we talk about buying and selling a lot, but the most important thing we do is holding, the valuation probably doesn't matter as much, right, over the long term. But if you are picking individual stocks and you're choosing the stocks to buy and you're choosing when to buy them, then I think the most important thing people can do better is not trying to get the perfect price on companies where the investment goal is disruption, very large growth in a very large market from a relatively small starting point. We chase valuation in those sorts of businesses, and then we rush to safety and overpay in these big, stable, blue chip businesses where getting a really good valuation is far more important. Because if you're buying a CrowdStrike or Zscaler or QuantumScape, any of these sorts of like disruptive hyper growth sorts of businesses, the thing that's going to deliver returns is going to be their ability to execute. If they execute really well, even if you pay a stretched valuation, 10 years from now, you're probably going to do pretty well, and you're probably going to have bought something that did better than the market did. If you pay 30 times earnings for any blue chip company that's growing revenues in mid-single digits and they're growing their earnings maybe a couple percentage points above that, you're probably going to get shitty returns over the next 5 or 10 years. So I think that's the thing. We go to safety when it's expensive, and we ignore and we focus too much on valuation when we're trying to buy disruptive businesses.
Yeah, I struggle with this still. Like I was just texting you today, like I might do this. And then a few minutes later, I was like, or not. Like I'm still trying to figure out, I'm thinking if I want to do different things in 2025, like part of me wants to buy a little starter position in like everything on my watch list.
Yeah.
And then just balloon my portfolio back up to like 55 stocks, which I don't want to do. And then part of me wants to sell everything, get down to like 10.
Right.
Yes.
Right.
I can't, and I'll feel differently in a week from now. So for me personally, I'm constantly thinking about what I might want to do differently, but I'm generally doing the same thing, which is on some fairly regular basis, putting money to work.
I'm going to say something really crude here, but I mean, my first 5 or 6 years as an investor, I was, again, this is a horrible thing to say, but like bulimic investor, where like my portfolio would get really big and then I would just purge it out and I would try to get to some arbitrary small number of stocks. And it took me a long time to really get comfortable with the idea of having a ton of stocks and a lot of them having very small positions, because I finally figured out what I was trying to accomplish, which was like the kind of the venture capital approach where I take these small bites in these more speculative businesses and then add to them as they prove out. I was talking to Tom Gardner on the Motley Fool's Q&A live stream yesterday, And one of the stocks that we were talking about, the idea of taking really small bites into disruptive, innovative companies. And one of the things that we like, the thing that brought it up was somebody asked a question about like a nuclear stock. And, nuclear is all the rage right now. And there's the idea of these small modular reactors, and there's startups that are working on it, and there's all this stuff. So everything's way overvalued. And Tom talked about this study that he read that talked about how, and some other investors that talked about how if they found something, they're like, hey, this could be a good idea. They almost every time would take some really small investments and get that skin in the game. Creates incentive, right? Get back to incentive, creates incentive to know what it is, to learn about it and study about it and follow your investment. And one of the stocks that I use to talk about how I've done that in the past was Mercado Libre. The first time I bought it was over a decade ago. It was a small position that's up, I don't know, 30x or something since I bought it. And I think I bought it 20 times total. I've invested in more shares of Mercado Libre. And every single time, except for one, every single time I averaged up. I paid more for the stock price. I wasn't trying to catch this perfect price. I found a winner, winning management, winning idea, winning execution, great tailwinds. And I'm not going to miss the opportunity to put more money into that sort of business, right?
Yeah. Here's the last thing I'll say about that aspect of buying. We'll use Mercado Libre as the example. Go look up the stock chart for Mercado Libre. Anyone who's listening, ticker symbol's MELI. And it generally has gone up and to the right from its IPO to now. Just pick a point along that chart and you would have been happy to buy there. Don't go to like 5 days ago and show me that it's down 2% or something like that, but like over any meaningful amount of time. Yep. Now, that's not the case with every stock, right? Some go up and come back down and never recover. And if you bought at the top, sorry, that didn't work out for you. But to your point about finding the winner and struggling with the buying, averaging up, that's what I kind of always imagine. Like you can do this with Apple and Amazon and Microsoft, Netflix, go back. There was probably some point in pick a year where someone looked at each of those companies and went, oh, man, it's doubled since I bought it. Can't pay that much. Meanwhile, that's like way at the bottom of this huge chart,
Right. That's exactly. I mean, in the moment, and again, in the moment, you look at the price action of a stock over a month or a year or a couple of years, and you can look at it and say, oh, that's where that was the best price. Oh, man, that 2 months before, God, that's 20% more. Wow. And then you hit that all-time thing. You're like, holy shit, that whole year, I can't even tell where it was. Like, I can't see any of it anymore.
Another fun thing to do, just to drive this point home, just look at a stock chart of the S&P 500 and do a 5-year look back from now. And even the COVID dip is starting to look like, oh, that's not that bad. And the 2022 one that felt so awful to live through, like we even did an episode called I Don't Know How to Invest Anymore in the middle of that. That doesn't even look that bad. And we're still only 2 years away from that. And then if you go to 10 years, if you go to 20 years, it's just, they're like little tiny, boop, on the huge chart. So yeah, perspective definitely can change how you think about those things. All right, last thing, let's flip the coin here, Jason. If we think about going back to basics for investors, how do we think about selling?
So this is one of my favorite things to talk about, because if we look at it from its most pure, everything's work. I love everything that I own. I don't want to sell anything, but it's time to sell something. It's because you've reached like a financial milestone. It's time to turn assets into money or turn stocks into bonds or CDs or whatever it may be. That's the most pure, perfect reason to sell. Congratulations, homie, you did it. You're there. You're there. It's time to reap the rewards of your labor. And that's the best. And that can be the hardest to sell too, because it's like, okay, so now you're telling me that I've got to sell some Apple and Nvidia and Trade Desk, and these companies are going to keep going up. I can wait a little longer. I don't have to sell now. I'm not retiring for 4 more years. I can get another year. Just imagine being the person in that situation in, say, I don't know, late 2021. And then you decide to sell in early 2023. You're down 20%. It's why it's so important to have the plan right? And know when your goals are and build a framework to support that. So that's like the best reason to sell is you've gotten there.
I mean, well, so let me just a personal story with that. I've mentioned this before. I keep saying I'm not saying it to brag. And I really, really am not saying it to brag, because this was a complete brainless, lucky timing of me buying NVIDIA. I bought it a bunch of little times, like probably $50 here, $80 there, $10. I mean, literally $10 there when I was really starting out. But I did all of that in like 2020 when the stock market was crashing. So I have $924.46 worth of cost basis in NVIDIA. Okay. And that was like, again, $10 and $20 buys over the course of probably a year or two. That is now worth $5,300. Okay. Now I am the 570% gain. I am far away from retirement. I don't need this money. It is not a life-changing amount of money. That's great. I'd love to have $5,000. I'm sorry, it's worth $6,200. I was looking at the gain, not the total.
Right. That was just the gain. Yeah.
Yeah. I'd love to have $6,000 more in my bank account right now. Like I could buy something nice with that. If I were 6 months away from retiring, I'd probably sell that. Or if it were 10 times that amount, obviously, like different story, different situation. Right. But there are people who face those decisions all the time. There's a very good chance when I do retire that's double that amount it is now, but it could happen where it's the same or lower. You never know. Like NVIDIA's top of the world right now. I don't know that they will be in 2040.
Right.
Right.
Key for me is that in those situations, this is exactly what you're talking about is that it's so easy to get trapped in the what it could do if I hold a little longer versus stepping back and say, wait, that's the down payment on my house. That's my kid's senior year of college tuition.
See, and that's where I think it would change for me. That's where so again, like if it were a dollar amount, I'll use because I've thought about this college thing. Because I've said before, I view my non-stock portfolio as the thing that I'm going to retire with. And my stock portfolio is like icing on the cake, where I might, because some of it's in a brokerage account, I might be lucky, catch a winner and be able to like do the thing people talk about, which is like sell a stock and buy the down payment on a retirement, like on a beach house or something like that, right? That would be great. I'm not planning on it. I'm not counting on it, but it would be really cool if I could. And I think that's a place where I might do it, right? If I'm coming up on the last year of paying for college for my second kid, let's just say, and I'll pick a random number, it's 30 grand. And that's all I have left. And I'm looking at my NVIDIA position and it's 32 grand. Like I might be like, okay, that's the time to do it.
Right. Yeah.
So anyway, we're talking around the idea of selling, but I think I like your idea. I just want to come back to, I like the idea of that is a way you have to think about it in certain circumstances, which is you made it. Like that's why you were doing this. Like this is the whole.
That's exactly it. It's so easy to forget why we're doing it and just focus on that we're doing it, that we can lose track of those financial goals and start making poor decisions. So I want to kind of step down the ladder of like the decision-making hierarchy of when to sell a stock. So the next step below, I'm at a financial goal. I need to reallocate asset allocation, right? Move stocks into bonds or CDs or whatever it might be. And then the next step below that is just rebalancing. We've talked a little bit about this, and that's something that I think more investors probably should be doing, especially in this higher interest rate environment where there's more money to be made, reducing volatility and kind of creating some dry powder when we do go through downturns. If you have a longer time frame, that maybe you can, again, by rebalancing in markets when they're high and when they're low, you're putting more money into stocks when they're cheap, and you're putting more money into bonds when stocks are expensive, right? So rebalancing is another time I think people should be selling. And both of those first two, this is just basic financial planning 101, right? And honestly, it's the stuff that for most of us is probably, if we're not doing it, we're leaving money on the table, right? And creating additional pools of risk that we don't necessarily think about. And those things can be worth tens and in some cases, maybe even hundreds of thousands of dollars over an investing career, like over an investing lifetime, right? It can be tons and tons of money, just the basic fundamental stuff. I mean, this is like, again, thinking about just a stupid sports analogy, the fundamental stuff getting some of those edge case extra free throws could be the reason why LeBron James now has the record for the most 30-point games in an NBA career, right? It's the little things like that that can add up and create incremental value. Then, of course, the next step below that, we get into, if we're talking about selling individual stocks, which we should be because all the other stuff is boring, then you start running into, do I have too much exposure to this individual company? This company did exactly what I bought it to do, but now it represents 25% of my net worth. At some point, like you've talked about somebody you know that turned a small investment in NVIDIA multiple decades ago into a 7-figure investment.
Yep.
At some point, you have to look at that and say, this is found money, right? Sure, NVIDIA could keep going up from here, but maybe it is time to kind of this, again, the same idea, but not maybe looking at it from the, I'm at my financial goals perspective, but this stock has exceeded all of my wildest expectations. Let me go ahead and take some of that and put it in something that's not NVIDIA, just in case this is GE in 1999, right?
Which also doesn't mean you have to sell the entire position either. It can be a trim. It can be, yeah.
Exactly. And then you start getting into the really like the individual company level stuff, the bad stuff. Like this company hasn't done well and I need to sell. I need to reduce my exposure. There's a competitor in the space that I like a lot that I haven't invested in. I've decided that I want to reduce my exposure to company A and buy some company B. And a lot of it, this is, I think the biggest one, is admitting when you're wrong, like acknowledging when you're wrong about a business. It's so easy, Jeff, to make excuses. Well, this has changed. Well, that's happened. Well, the business dynamics have changed. The industry opportunity has moved. Interest rates are higher. Interest rates are lower. All that crap we can throw out there to justify for many, many years a business not creating per share value for investors. Boston Omaha, I think, is a good example, right? You can always find a reason to wait a little bit longer. And I will say this, I think you should wait. I think investors should be glacial about selling. But at some point, particularly if you're spending an outsized amount of your time working on this idea or thinking about this idea versus what it represents in your portfolio, time that you could be productively working on other things, sometimes it's time just to move on and cut your losses.
Yeah. Selling is such a fraught topic. There's so many things that go into it. Like, what is the company? How much do you have invested in it? Where are you in your life? What's your temperament? I mean, this is why we've done entire episodes on it, and we are running long here. So I'm going to wrap this part of the conversation. I'm going to wrap the whole podcast up by, this is my like one line thought about selling that I've kind of landed on, which is you should sell after you've given it a lot of thought.
Yeah.
I think if most investors just did that, if they really only sold after like just giving it serious consideration, which eliminates the, oh, it's down 20% today on news, I'm selling, or yeah, I've had this for 3 weeks and I'm whatever. If you can just eliminate some of those spur of the moment gut reaction sort of reasons to sell, I think you probably eliminate a lot of mistakes. Not all of them. It's not a perfect system. I don't think it's something that can be distilled down to just one thing. You use the term, and I like it, being glacial about selling.
Yeah.
And I think that's largely right. I think that's kind of where my head is too. It doesn't guarantee you're going to make the right decision, but I think a reasoned, well thought out sell decision is going to be better than a snap sell decision, just generally.
Yeah. And sometimes a good starting point when you're in that position where you've become kind of intractable about it or you don't know what to do is to ask yourself the question, say, how excited would I be? Not would I, but how excited would I be to buy this stock if I had never owned it before? And like, I would look at a business, I'm beating up on Boston Omaha right now. I would look at that and be like, that's a dog. No. And sometimes that can be the thing to push you over the edge. It can also help you maybe put fresh eyes and be like, oh, yeah, there's some things that are happening right now and I think it's misunderstood. Maybe I should buy more. Because you get so caught up in the fact that it's been a dog in your portfolio, sometimes you forget to focus on the opportunities and risks of the business. Jeff, we're running along. This is one of the longer episodes we've done in a while here. Any last thoughts? I've got a couple little last thoughts for 30 seconds or so, but anything before we wrap up from you?
No, I just want to reiterate what I said at the top. Like, we purposely wanted this to be a little unwieldy in terms of the conversation. So if anyone has a more focused part of this that they think would be a fun conversation, we'd love to hear it. Email us, reach out to us on social media, however you want to get your ideas to us.
Yeah, do that. The one thing I want to add as we wrap it up is that all of these things matter and they're important, but only if you have some method to kind of track everything that you're doing, not just track the performance of the stocks you own, but to help you go back in time and to think about when you did things, why you did them, how you were feeling when you did them, because that can really inform a lot of your decisions and help you identify mistakes of commission and build things in your process to keep you from making those kind of mistakes, but also figure out the things you've done that were really good. And there was something innate about your actions that was behind it. So you can grease the skids and do those sorts of things more. So simplifying and like going through your entire process, I think is a way that you can kind of help do that. Okay. As always, friends, we love to weigh in on these topics, share our thoughts, give our answers, but it's up to you to find your own answers to these hard investing questions out there. It's a fun journey and it's challenging. You can figure out the things that you need to do on your own, maybe with a little bit of help. Blah, blah, blah. But you know what? You can figure out the right answers for yourself. I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.